So Chapter 8, we're going to look at liabilities and stock. So when we look at a company, they can finance its operations two different ways. Debt financing, so liabilities that we owe. So we go borrow money from a bank, that would be debt financing. Or we could do equity financing, investments from owners. We can issue stock. Or we can use one of these methods, or we can use both. But a company, there comes a point where you need to get money to buy new equipment, pay your employees, expand, and you can get the money two different ways. You can do debt, you can take out a loan, or you can sell a bond, or there's equity financing, which you can issue some stock. So, some liabilities. Liabilities, debts owed to other. We know current liabilities are due within a year. So if I go buy some supplies on account and it's due within 60 days, that's a current liability. Long-term liabilities are due beyond a year. And then we also have liabilities that are contingent on the outcome of other events. So this has to happen for this to happen. So a note payable is more formal than an accounts payable. So accounts payable would be we go to Staples, we buy some staplers, we get an invoice, and we pay it later on. That's accounts payable. A note payable would be like the mortgage on your house, where it's more formal, it's a longer document, it's more legally binding. It usually bears interest. So when you buy your house, you buy your car, those would be examples of notes payable, and you typically have to pay interest on those loans. Whereas our invoice from Staples, where we buy $500 worth of staplers, there's usually not interest on it. We just pay it within 30 days. It's issued to creditors. So let's look at an example. So we assume that a business, we issue a 90-day 6% note for $1,000. So what we're going to do is, since we're doing this to satisfy an account payable, we're going to reduce accounts payable and increase notes payable. So it's still a liability, we're just calling it something different. And now when we actually pay the note, we're not going to pay $1,000 in cash, we're going to pay $1,015 in cash. That's our 6% interest that we have to pay on the note. So our cash out is $1,015. We reduce our note payable by $1,000. And then we have interest expense for $15 on our income statement. So we paid $15 of interest plus our $1,000 note. So our total cash paid was $1,015. The $15 is calculated by prorating the 6%. So if you take the 6%, that's over a year. So you have to prorate it back to 90 days to calculate the $15. So income taxes. Everybody loves income taxes. You have federal tax, state tax, and maybe even local taxes depending on where you are. So if anybody works in Detroit or Pontiac, you know that you have to pay a city tax there in addition to state and federal. Typically, corporations pay federal income tax quarterly, so there'd be 4 installments throughout the year. So taxable income, there's a definition from the IRS on what taxable income is. So your revenue minus allowed expenses, deductions, and whatnot, that becomes your taxable income. Your income before taxes is determined according to GAAP, generally accepted accounting principles. So you can see that there could be a difference between what taxable income is based on the IRS rules and what income before taxes is based on GAAP. There's differences between GAAP and the IRS rules. It's not the same. So sometimes companies keep 2 sets of books, a tax set of books and a GAAP financial reporting set of books. And then the differences between the two have to be allocated between financial statement periods. So we're going to look at permanent and temporary differences. So we see our Exhibit 1, revenues and expenses comes to taxable income per tax laws, could be different than revenues minus expenses, income before taxes, GAAP financial reporting. So there can be a difference. So let's look at account for temporary differences. So we have our income before taxes on our income statement. That's GAAP. Less our temporary differences gets us to our taxable income, which we show on our tax return. And then we have a 40% tax rate. So what we're showing here is that our income before taxes on our income statement per GAAP is $300,000. Our taxable income on our tax return when we do our taxes comes out to $100,000. There's a difference of $200,000 between the two. It's a temporary difference of $200,000. So our income tax expense based on the $300,000 from our income statement would be $120,000. Our income tax based on the $100,000 that we're actually going to pay is $40,000. So that means there's an $80,000 income tax that we're not paying, that's the difference between what we would be paid for our GAAP income statement and our tax return. It's $80,000. So it's called a temporary difference because at some point they're going to catch up to each other. So over time, we're going to pay that $80,000 eventually. Just not this year. It's deferred to future years. So our tax liability is $40,000 instead of $120,000. But that $80,000 at some point we're going to have to pay it. That's why it's called a temporary difference. So to record this, we create our income tax payable account for $40,000. And the $40,000 is our taxable income per our tax return that we're actually going to pay times 40%. We're going to create another liability called deferred income tax payable, which is our $80,000. The difference between the $300,000 at 40% and the $100,000 at 40%. And then on our income statement, we're going to show income tax expense, which reduces retained earnings. Contingent liabilities. So the contingent liability is a liability that's contingent on something happening. So for instance, a lawsuit. You having to pay somebody is contingent on you losing a lawsuit. So that's called a contingent liability. And there's different accounting treatments for these liabilities too. So sometimes we have to disclose the liability, which simply disclosing the liability would just be talking about it in the footnotes of our financial statements. Sometimes we have to actually record the liability, which would be putting it on our balance sheet. And sometimes we don't do anything. So the standard is we have a contingency, and there's three different likelihoods of it happening: probable, reasonably possible, or remote. If it's remote, so if it's a frivolous lawsuit, it's a remote chance that we're going to have to pay. We don't have to do anything about it. If we have a lawsuit and it's reasonably possible that we're going to have to pay, then we disclose the liability in the footnotes of our financial statements. We don't record it on our balance sheet, we just disclose it. If it's probable, if we think we're getting sued, we think we're going to have to pay, and we can estimate it, we have to record it on our balance sheet and show it in the footnotes. If it's probable that it's going to happen, but we can't estimate how much, we have to talk about it and disclose it, but we don't record it on our balance sheet. And finally, payroll. Payroll is what we pay to the employees for doing something over a period. So two types of ways you can get paid. You can get salary or wages. Salary payment for management, administrative, wages for manual labor, skilled and unskilled. In payroll and taxes, definitely impact the net income of a business because, most businesses that you typically have people in some capacity that you're paying to do work. So when you have to pay people to do something, you have to recognize expense for the salary and wages that they earn. So to record payroll, and we'll dive into this a little bit more. So we reduce cash because money's going out the door to pay. And then we have some liabilities, FICA, federal income tax payable, and state tax payable that we have to pay the government. And then adding all that together, we have our wages and salary expense on our income statement, which reduces retained earnings. And we'll get more into this. So the payroll taxes, so the employer, actually let's start with the employee. So the employee, you're responsible for paying FICA and federal and state income tax. So if you go look at your pay stub right now, you'll see that you're paying FICA and you're paying federal and state income taxes. The employer has to match what you pay in FICA, and then the employer pays federal and state unemployment taxes on your behalf. So you don't pay federal and state unemployment, the employer does. And then you both pay FICA and you pay federal and state income tax. So payroll taxes become a liability when the related payroll is paid to the employees. And then the liability is taken off the books when the taxes are paid to the appropriate agencies. So when the money is taken out of your check for FICA and federal and state income taxes, you're not paying the government. Your employer withholds the money from your paycheck, and the employer is the one that actually writes a check to the government agencies. So the government withholds that money from your paycheck, and they have a liability because they have to take that money and pay it to the government agencies. So you don't pay the government directly, your employer does. Thus, your employer has a liability on their books because they owe the government authorities money.